saying, but the most important part of a real estate deal is having the money to fund it. So, with so much conflicting advice out there right now, especially in American culture, the majority of our population is in debt to the gills. Some have been told that the debt is bad, to avoid it at all costs, under any circumstances, avoid debt, while others, keep debt close, and they are in debt, and they use debt to leverage their money to make more money. So there's two big ways to finance real estate deals, and that's through buying cash, number one, or number two, financing. So this article here did a pretty good job of explaining the cash versus financing argument. So being in a position to pay cash when buying an investment can be rewarding. At the end of the day, not carrying a loan in your real estate investment is a major relief, since you don't have to worry about paying your mortgage payments. The method of financing you choose depends on your financial situation. Okay, number one, so attractiveness to sellers. This is a big one. So the upside to paying cash is that you're not carrying a loan, nor do you have to make monthly payments. So again, try to use discretion and do what makes sense. It's probably not the best idea to spend all of the cash you have, all of your cash reserves, strictly on real estate. It's also not the best idea to have a costly mortgage. So try to find that happy medium and figure out what works best for you. But in terms of actually doing the deal, you have attractiveness to sellers. With a cash buyer, property sellers have no concerns about the loan process, which makes the whole process faster, more flexible. In many situations, closing the deal is delayed due to mortgage pending. Therefore, buying in cash saves the property seller's time. Moreover, the cash buyer has more leverage to negotiate a better deal. Pretty self-explanatory. It saves you time. It saves the seller of the property you're looking to acquire. It saves their time, and it puts you in a good position to negotiate a better deal. Number two, owning 100% of the equity. So basically, just saying that if you do purchase the property, you have 100% equity in it. So in the event that you do have some sort of unforeseen financial issue, later down the road, whenever that may be, you can pull cash out of the house to get a bank loan if need be. And immediate cash flow. So again, if you pay cash for a house when buying a rental property, theoretically speaking, you can start making money on day one, and you can have a positive cash flow. And that's mainly because you're not paying those monthly mortgage payments, which are with interest, and those can also eat up part of your rental income, assuming that you can find tenants. So, and no interest payments, kind of what I just mentioned. So having those interest payments in the mortgage, it can be very advantageous. Not having them and paying that interest can eat up your equity that you have in the home. Again, it depends on what you're doing and what your strategy is. So we went through a few of the pros. So here are the cons. So let's be honest, paying that much money for a single investment property will cost you a lot of liquid assets. Real estate investors should never opt for this method of financing unless they have a large pool of cash laying around. Again, so it's basically just suggesting that if you're going to pay cash, you have a decent amount of liquid assets. So if you don't think that you have a decent amount of cash to put away into real estate, it's probably best not to, until you have a chunk that you feel comfortable with. So number two, missing out on tax benefits. So again, a big reason why people invest in real estate are because of the tax benefits. So financing investment properties means cash. With cash means that you have to pay tax on all your rental income minus the rental expenses, thus missing out on the benefit of rental property tax reduction. A major advantage of buying a house in cash versus mortgages is that with mortgage financing, you can deduct interest payments from your taxable rental income. That's a nice perk. Less diversification. So a lot of people try to diversify their portfolios. Again, this is to your own personal taste. Some do believe in diversification, whereas others like strictly one type of real estate and strictly stick to that. So again, it depends on what your strategy is. So there's cash. Now let's look at the mortgage argument here. So they both definitely have their pros and cons, but pros in mortgage financing, potential for higher returns. So it gives a nice little example here. Let's say you pay $100,000 cash for your rental property. it appreciates at 4% per year. Your return would be 4,000 per year, right? So assume you divide the cash you have into four bundles. So you're dividing the 100,000 by four, 25K, and you buy four investment properties, adding a $75,000 loan to each. Then it appreciates at 4%. So your wealth is accumulating to 16,000 per year, as opposed to just four. So with the same amount of cash invested, that $100,000, there's potential to make a higher return. So what we just explained right here, that is what you would call leverage. That's the beauty of leverage. In real estate, you're investing the same amount of cash. However, in one circumstance, you're leveraging it. That's the idea of using this type of financing. You're leveraging the money you have to make you more in the long run. Tax benefits, again, as mentioned earlier, mortgage interest can be deducted from taxable income, an advantage to real estate investors to lower cost of investment. Buying a house with limited funds. So with mortgage financing, buying a house with little or no money is possible. You just need a good credit to get a bank loan. So that can definitely work out well. Again, it's good to check because some of these rates have changed due to the economic situation. And cons of mortgage financing. The risk of foreclosure, obviously, if you don't pay on time, defaulting on the loan, it can put you at risk of losing the investment to the lender. Vacancies, if you're gonna have a rental property, this may sound kind of self-explanatory, but making sure that there are tenants in there, because you do run the risk of having a negative cash flow, and that's not good because that eats up your money. Mortgage process. Opting for this strategy requires you to go through the mortgage process. So after the housing crisis of 2008, banks have become more strict with issuing mortgages. However, if you have a good credit score and can pay your mortgage payments, you're okay. And so the lending parameters have gotten a bit more strict since 2008. And in some ways, they have gotten strict in March due to the economic situation that we've been facing across the globe. However, a lot of real estate investors use hard money lenders to leverage their money. So a good flexible hard money lender can get you funded quickly and could potentially close in 7 to 10 business days. So you don't have to deal with all of the red tape that you would with a normal conventional bank. A conventional bank, it could take you 60 days to close. Whereas with a hard money lender, it could be 7 to 10. You don't have to deal with all of the red tape. And it's definitely a good idea to link up with a good lender. That's definitely crucial. So above all, it's important to know your situation, your current financial situation, how much money you have to work with, and ultimately what your goals are, and just putting one foot in front of the other. So creating a strategy that works for you, recognizing there's never a one size fits all. What works for your neighbor may not work for you. What works for you may not work for your neighbor, whichever. But once you find the financing method that works for you, pat yourself on the back because you've taken care of a big part of your deal. Take care.